everyone. My name is Keshav Kulwar. Welcome to the Clive Capital webinar series, where we bring on different guests and experts to talk about not only real estate investing, but also general wealth building topics. And before we get started today, just a quick disclaimer that the information presented here is just for educational and entertainment purposes. We're not tax, legal, or financial advisors, and this advice is not meant to be taken as such. We advise that you consult such professionals when making these decisions. And with that, let's get started. Today, I have here with me Jack Carlson. Jack, I met Jack on LinkedIn. He introduced me to the wonderful concept of infinite banking, which I'm still learning about myself. But I thought I'd share it with you all because I think it's a very amazing tool to build your wealth, regardless of what asset you invest in, whether that's crypto, stocks, real estate, businesses, etc. And Jack, a little background about himself real quick. He's helped over 50 clients implement the infinite banking system in their own lives to help them achieve financial freedom quicker by, instead of letting your dollar work once only in your investments, having it work twice, growing both in a life insurance policy and in your investments. And with that, I will let Jack take it away.
Thanks, Keshav. Yeah, great to be with you all tonight. I'm going to pull up a presentation to walk through so you can see some visuals. But yeah, the topic we're going to focus in on is infinite banking. The question that I want to answer for you all tonight through infinite banking is, what is the best place to store your capital before deploying it for investments like real estate or entrepreneurial ventures, major life purchases? Some of my background is actually in more traditional finance. I studied it in college and had a short work stint at Morgan Stanley. And most of the advice that I saw given in these settings was basically to send the majority of your savings away from you into accounts that you don't control or can't access until much farther down the road, and kind of like defer management of building future income streams to someone else. And I wasn't very satisfied with that advice and actually wondered, what if the flip side of that was true, that the majority of your savings flowed into an account that you do control, so that when investment opportunities come along to invest in cash flowing assets that can produce income for you today, you can actually significantly take advantage of those opportunities. And that's when I came across the infinite banking concept about 3 years ago. I was introduced to this strategy by Unbridled Wealth, and first became actually a client and then an agent and strategist with Unbridled Wealth. And yeah, I thought a cool place to start tonight is just some of Unbridled story. And yeah, I think it gives vision for what is possible when you insert the infinite banking system into, in this case, a business's financial plan, but we'll see that it applies just as well to individuals too. So Unbridled is a family of 28 companies and growing. The first one was actually a corporate events company. And about 8 years ago, the founder of Unbridled, Stan Bullis, learned about the infinite banking concept when there were just 3 total companies. And he began storing up profits and retained earnings to the tune of like $1 million into these specially designed life insurance policies. And it essentially served as a pool of capital that was growing for the rest of his life, but also accessible, and provided the seed funds to launch many other adjacent businesses like Unbridled Media, Unbridled Travel, Unbridled Productions, and as well acquired 10 historic buildings throughout Colorado with funds from these policies. Before I go any farther though, I want to just emphasize that having a why or a vision for your wealth strategy is probably as important or more than the actual strategy itself. And for Stan and Unbridled, the big vision was to restore people and places. And in this picture, this is Canyon Peak, Colorado. This is a town where 50% of the population in this county is either in prison or works in the prison system. And Stan got this idea of, what if a town known for locking people up became known instead for hospitality and setting people free? And the first purchase he made was this hotel on the corner, Hotel St. Cloud. He bought on auction for $88,000. After this happened, he realized, I'm getting pretty good cash discount prices on these historic buildings. And he proceeded to buy an event center, a restaurant, a co-working space, a luxury hotel, an ice cream shop, all in cash, borrowing against the life insurance policies, and then doing cash out refis on these buildings, paying back the policies, housing them with businesses, and just seeing flourishing happen on Main Street in this city. So yeah, I want to start with that, just to show what is possible when you implement strategy. And what we're going to unpack together in the next 25 or 30 minutes is this. I want you to all be able to think about, like, what is your why in your wealth building strategy? Second, what does default financial advice produce for you? And is that the path that you want to walk down? And then lastly, what is the infinite banking concept? How does it work? And how could it potentially provide a better path forward for you in achieving your financial goals? And we'll leave adequate time for questions at the end too. So what's your why? Some of this language comes from a guy named Simon Sinek, and he says the best way to figure out your why is sit down with a couple of close friends, not family members, and ask them, why are we friends? And some of what will come about when you ask this is your friends will get to the core of who you are, how you're uniquely wired. And some of that is what you should kind of set in front of your life for your why. And then if we can align a wealth strategy to that, I think amazing things can happen. So this is my why, and what will kind of guide us the rest of this evening. It's to uncover financial realities that broaden perspective and enable people to forge a more satisfying, efficient path to financial freedom and intentional living. So we're going to start by looking at what is the current context of money for people in the US. And with this, I want to basically show that most people systematically or paycheck by paycheck are sending money out of their control. Dollars are getting sent to 401ks where money is inaccessible until age 59 and a half, unless you pay penalties and taxes. We get taxes deducted from our paycheck, often in amounts greater than what we owe. And we're essentially loaning the government tax-free dollars that we have to ask back in April every year, a tax return. Banks, we direct deposit our funds to banks. This is tricky because we have access to the money we put in banks, but if you bank with Bank of America, they on average last year gave their depositors 2%, and they loaned out funds at 5.2%. And because of our fractional reserve system, they can loan out 90% of the deposits they have on hand, and that earns them quadruple digit returns. So that's where infinite banking kind of connects. We're posing the question, what could happen if you play the role of banker in your own financial plan? And yeah, we'll actually follow the balance sheets of banks in a few slides here and discover they're using the same financial vehicle that fuels the infinite banking concept. And it's pretty cool. Lastly, most Americans are protecting themselves through term life insurance, paying for that on a monthly basis for 20, 30, 40 years. And it's a cheap way to provide a death benefit, but 98% of them actually never pay out a death benefit, thankfully, because people often aren't young. But this just means that premiums are lost to the carrier for years, and oftentimes no legacy is left behind for family. So as you kind of zoom out and see some of these realities, the question comes out, what's the value of a dollar that you don't have access to? How are we going to fund our other investments and do that in an efficient manner? Before we dive into infinite banking more, Keshav asked me to give a snapshot of how money grows in 401k. This is a little experiment I did, basically giving a snapshot of $100,000 invested in the S&P 500 and how that performed from the years 2000 to 2020. I also put the average 401k fees according to Smart Asset on the side. When you include plan, service, and fund fees, they come out to 2.2%. So you see the impact of fees on the side here. And this isn't like 100% accurate because like most people would continue contributing to a 401k on a monthly basis. I just put a lump sum in, but you can still kind of see the impact here. So early 2000s, we're down negative 43% in the first few years, over 60% the next 5, but still didn't break even yet. And then the housing market crash happened. But the last 12 years or so, we've had some of the largest expansion of the US economy ever and great returns in the stock market. But the summary statistics after these 20 years are that you have an end balance of $246,000. The real annual return when these are included is 4.61% after $50,000 in fees were paid. The average annual return, which is often quoted and sound a lot better, was 8.19%, but averages don't actually accurately account for negative years in the stock market. And then if you withdrew in the 15% tax bracket, your real annual return would drop under 4% to 3.76%. This was a pretty startling experiment for me. Made me kind of angry just when I dug in about fees. John Bogle, the Vanguard founder, says what happens in your 401k is that the magic of compounding returns is overwhelmed by the tyranny of compounding fees. It's a mathematical fact. You can see as balance grows, the fees that you pay also grow, and that's what he's speaking to here. And NerdWallet also did a study and found that just a 1% fee over 4 years, when someone's depositing 10K a year into an account and it's growing at 7%, would erode $590,000 in retirement savings. So I'm not trying to just bash on qualified plans, but I am wanting you to vet this as an investment opportunity too, and consider there are variables as a part of this, fees, taxes, volatility, that seriously can impact returns in the long run. And yeah, with that, I want to kind of hone in on like, what is the financial goal of work? For most, it's to provide for themselves in the present, and then to work towards building passive income streams that exceed monthly expenses so that work becomes optional in the future. The tool most people are using to accomplish this is qualified plans, 401ks, Roth IRAs. And some of the numbers around are like you would need to accumulate $3.3 million in a qualified plan to replace an income of $100,000 a year. That's because you can sustainably withdraw 3% a year in retirement and be certain that your money won't run out before you die. But you have to wait till after age 59 and a half to do this. And yeah, like what I want you to consider with this is a $3.3 million asset over 40 years is providing about $8,300 a month in income. And as you get around real estate and other investment opportunities, you'll find this pretty inefficient. And yeah, and if it's a traditional qualified plan, like taxes will be paid at an unknown future rate. So you don't actually know like the percentage that you'll take home at the end of the day. And I think if if you set this up against other opportunities, and you should, you'll find that it's worth it to look into other things and maybe have this as part of your plan, not the primary part. Like true diversification includes different asset classes, not just diversification within the stock market. So now we're going to transition to some of what I was earlier with infinite banking, like what's the optimal way to pay for things throughout and fund other investments. This is going to contrast the saver who saves up in a bank account to fund a syndication, a property, a car, vacation. The process the saver goes through is to work hard and save up over time. When they have enough for what they need, they withdraw those funds and invest or pay for what they need, and then start over again for the next thing that's coming their way. This is better than going into consumer debt for something, paying extra in interest. But what most people don't consider is that the first $100,000 you save up, if that was able to continue growing over the next 40 years, that can become $700,000, growing at just 6%. And the vehicle that the Wealth Creator is using is the cash value of a permanent life insurance policy. So first 100,000 saved up is going to grow the rest of your life, but is also available to use. You're just going to access dollars differently from your policy. Rather than withdrawing from it like you would a bank account, you can borrow against the amount that you've built up in your cash value and take a policy loan to invest or pay for what you need. And then rather than saving back up like the saver from zero, the Wealth Creator is going to save back up by paying off this loan to their policy on their own terms. We'll get into that more in a second. While this loan is out, the full $100,000 that they've saved up is continuing to compound on that full amount. So you're essentially combining the process of both earning interest on your original savings while using the life insurance carrier's money to invest in another asset that earns another rate of return. And yeah, you can continue using this process through life and end up in a much higher net worth position than you would if you just ran things through a bank account or a brokerage account. So this is kind of the big picture. We'll get into nuts and bolts in a second, but want to kind of follow balance sheets, like I said at first, and see who else is using this strategy, because it isn't talked about a lot in the financial mainstream. And this quote from a documentary about taxes is pretty telling though. So it says, the single biggest benefit in the US tax code and the most unused is the income tax exemption on permanent life insurance. This is because with life insurance, when you're accessing cash value via a policy loan, loans are not taxable. So you can even access gains on your policy via a loan and never pay taxes. And unlike, let's say like a Roth IRA that you're funding in a similar manner with after-tax dollars, you can fund these policies to the tune of hundreds of thousands of dollars a year and be building this this asset that you can access tax-free for lots of different things throughout life. So where do banks store large amounts of their tier one capital? In the cash value of permanent life insurance. They insure their key employees at max amounts and store large amounts of their capital in the asset as well. And real estate is a focus of this group. And just to look at Wells Fargo and the amount that they hold in real estate on their balance sheet, it's over $11 billion, but they own almost double that in life insurance. So this for me kind of brought up the question of, do banks know something that we don't about this asset class, or are they using this way that most people aren't aware of. And yeah, the reality is Fortune 500 companies are storing capital in this asset too. Most politicians store money in this asset. Joe Biden actually releases financials, and he owns 7 different whole life policies, runs a lot of his financial life through those policies. So this is just to say that this asset has been around since the 1800s. It predates the tax code, and significant financial players in our country are utilizing it, and you can too. So, going to break down how does this actually work? Private banking system fundamentals. So this is still life insurance. There's a death benefit involved in it. It can be individually or corporately owned. With permanent life insurance as opposed to term life insurance, the death benefit is guaranteed to be paid out, which makes it a really efficient way to pass on wealth to future generations. You can also access a portion of death benefit while living if terminal, chronic, or critical illness occurs. And then in most states, the funds in your life insurance policy are creditor protected, meaning that if you're ever to be sued, the funds in your policy are off limits, primarily because it's a private contract with the life insurance carrier, and it's not reported financially because most of the time there's no taxable events happening with the policy. The cash value is essentially access you have to the death benefit while you're living, and it's really the key to making this a banking system. It's your pool of capital that you can borrow against, and the cash value grows on a guaranteed basis along with dividends. We're working with mutual carriers as opposed to stock-owned carriers. Mutual carriers are owned by their policyholders. So as a policyholder, you partake in profits of the company through a dividend. The 2 primary carriers that Unbridled Wealth works with, they haven't missed dividend in their whole existence. So though dividends aren't guaranteed, they've never not been paid out, and provide significant growth and compounding in your cash value as well. Guaranteed self-directed liquidity, meaning you can access the cash value at any time for any reason, and it continues growing for the rest of your life, whether you have loans out or not. And then also you can flexibly fund it. So there's kind of a floor and ceiling of what you can pay into a policy each year, and that can be fitted to your current financial situation. Lastly, the lending aspect. So 95% of your cash value you can borrow against and take a loan out. The current interest rate on policy loans is a fixed 4%. There's also a variable option too that was lower than 4% recently, now is higher than 4% with our rising interest rates. If policy loans are used for a business or investment purpose, policy loan interest can actually be deducted from taxes. That's something to check with your CPA, but that's what we've done at Unbridled with loan interest. And this is one of the big keys in this next one. The entire cash value continues to grow even while a loan is out. So Keisha mentioned this earlier. With this, like your dollar growing and compounding in the cash value and out doing something else for you at the same time. And we call that multitasking dollars. It's really powerful when you're able to give $1 multiple jobs. And that's pretty different from how most people function in their financial life. Most people have an emergency fund for this, a 529 plan to pay for kids' college, 401k, IRAs to pay for retirement. And that's some of what I was saying. What if a lot of your savings could be redirected into a place that's going to grow for the rest of your life and be accessible to you when opportunities come along? And this last part I'll show with numbers in just a moment, but get to a point in your policy where interest earned on your cash value outpaces interest paid on a loan, and you get what we call positive arbitrage. So what things could look like as you consider implementing a private banking system into your own life is looking at what's your free cash flow? Where are dollars currently sitting or going to that we can't access or isn't growing efficiently? And how can we redirect dollars to the cash value of our policy so that we can free it up to invest in other things while growing those dollars? Okay, so this slide is going to bring it all together with a numerical example. These are the three categories within a permanent life insurance policy. The premium is what you pay in, either on a monthly or annual basis. It can be flexible to your situation. The cash value is that pool of capital that you can borrow against and can function as your banking system. And then the death benefit. So in this example, this person is a 32-year-old, good health, and they're paying $100,000 a year into this policy. That 100,000 is broken into two parts, what's known as the base premium. The base premium primarily funds the death benefit in year one. It's kind of like the cost of insurance portion of the premium. And the remaining portion of the premium is called paid additions. It's an optional overfunding part of the premium, and it buys a very small amount of death benefit, but primarily goes to the cash value. And yeah, just a note. So we like to say clear is kind at Unbridled Wealth. And so you know how agents get paid. In year one of a policy, a life insurance agent makes 50% of the base premium. So we are structuring the policies to drive down the base premium as much as the government allows, so that this still qualifies as life insurance for the tax favorability, but does not become what's called a modified endowment contract. A MEC is basically the government saying this is acting more like an investment than life insurance, so we're going to tax when you use funds from it. So year one of this policy, you'd put 100 in, you'd have access to 81 right away to borrow out. Year two, if you paid another 100 in, it would grow to 170. And by year 10 on this policy, paying 100 a year in, your cash value's now 1.2 million. So you get to a point usually about year 5 of a whole life insurance policy where your cash value is greater than the amount that you've paid in. We call that cash in, cash out whole. Excuse me. We'll touch on another type of policy in a moment called, sorry about that, called Index Universal Life. And with this policy, you can have access to the full amount that you paid in, usually by year 2 or 3. So I'm going to do a quick example now. So you know you could access a policy loan from day one if you fund this policy with $100,000, accessing that $81,000. I'm going to skip ahead to year 10 when the cash value is 1.2 million, and show an example of taking out a $1 million policy loan for a significant real estate project or investment. The interest on that is 4%. So we're going to assume in this example that over the 10 years, you pay interest only on the loan, $40,000 a year, and then maybe sell off that asset 10 years down the road to pay back the loan and have the return that the real estate gave you. When this is happening, if you're in the 30% tax bracket, say you can deduct $120,000 of that total interest. But on the flip side of this, so that $1 million is funds from the life insurance carrier's general account. It's not coming from your cash value. So the full amount of your cash value will continue compounding. And over those 10 years, it will grow by $1.02 million. And this is where you find yourself in the position that the banks find themselves in. Basically, are you willing to pay $280,000 of interest for the use of 1 million of the life insurance carrier's money to buy a significant asset? And while that's happening, have your dollars earn 1.02 million so that you net 740,000 in interest during that time. If you compared this to a bank, you'd just pull out that million. You wouldn't have interest payments, but your $200,000 would just be sitting in the bank during that time. So this is a way to insert a more dynamic asset into the flow of your money and basically honor your dollar's ability to grow over the course of your life while still being accessible, providing a significant death benefit and a lot of other things as well. So yeah, this is a key example to understand. I wanted to show you a quick client case study as well. This was one of my first clients. Actually, he's a nonprofit leader in his 30s, combined annual income between him and his spouse of 100,000. He actually took funds from his 401k during the CARES Act when they waived the 10% early withdrawal penalty, some additional liquidity to fund the first year of his policy, which was $5,000. In year one, he viewed the policy more as like an emergency fund, paid for a furnace that went out in his house and kind of set up a loan to repay that. Year two, though, he did a cash out refi on his home, got $80,000. He found a company that was offering promissory notes at 10%, took a policy loan and put $30,000 into that, which brought in $250 a month for that year. Then he used a portion of his home equity and vetted a blockchain banking opportunity that brought in $6,000 a month for him. Year three, he received that promissory note back, paid off the policy loan, and then and is continuing to fund premiums during this time, and took out a partial policy loan and put it into an oil lease that is earning $3,000 to $4,000 a month in interest royalties. So yeah, I share this because infinite banking is what got inserted into this family's plan, but the mindset that it unlocked of, wow, now I have access to my capital, and just because of the network that I have and that this client have, he came across opportunities that were really significant and that he was able to act on to now have a passive income that is basically exceeding the income from his work at this point. Doesn't always happen in 3 years, but I think you can significantly expedite your financial freedom journey by putting yourself in the driver's with your money and being able to vet opportunities that you may not have been aware of had you not had access to your dollars. So in summary, some problems that infinite banking can solve for you: can provide guaranteed returns and dividends, liquidity and control of your capital, uninterrupted growth while using your dollars via policy loans, can provide tax-free retirement income that can supplement your retirement, tax-free death benefit, long-term care protection, creditor protection, and some of what I mentioned of what this can be used for. Part of the part that's in the title, infinite banking concept, like the idea is people have found to put these dollars to work are infinite, but what we see most people using it for are as a savings or emergency fund at first. dollars to invest in real estate. We're a lot of real estate investors, major purchases, education or debt refinancing. This is a great way if you have higher interest student loans or credit card debt to run money through a policy and basically refinance your loan with you as the bank, and then retirement income supplement. Here's a little about where you can find me. Yeah, happy to do a free strategy call and talk through more of your situation and how infinite banking could be to where you're at. I'm active on LinkedIn and can also email me at jcarlson@unbridledwealth.com. And yeah, here's some good resources too, where you can continue the learning around this strategy. Some podcasts, a few books, and then a YouTube video that my team put together, kind of walking through the different products and how they can be utilized in different ways for infinite banking. So that's about what I have for now, Keshav. Happy to answer questions you've got, questions you have, and continue the conversation for the next 20 minutes or so.
Yeah, that sounds good. Thanks for running through that, Jack. Does anyone have any questions? Okay. So if not, we can jump into some questions that I think would be beneficial for our audience, just to give them a better picture. So there's 3 types of life insurance policies, right? That you mentioned: term, whole life, and universal.
Yeah, there are several. Yeah, the 2 primary ones we're using for infinite banking are whole life insurance and index universal life insurance.
Okay. Let's run through on that whiteboarding tool, maybe just some of the pros and cons, and really kind of compare the 2 to see, depending on your situation, which one might be more beneficial for you.
Yep. So yeah, IULs, they also are a permanent product, meaning that the death benefit is guaranteed to be paid out. The way the cash value grows is a little bit different. So with IUL, you can track a stock market index like the S&P 500, Russell 2000. There are several different options, and basically the growth of your cash value is based on that. Cool, because there's a 0% floor, meaning if there's a negative year in the stock market, that you just get a 0% credit on your cash value that year. And then when there's growth in the market, you can get up to a 10% return. That's the current cap. Some of the indexes are uncapped, so you could get even higher returns and credit to your cash value in that situation. So tracks with stock market index.
And IUL stands for Index Universal Life Insurance.
Yep, correct. Index Universal Life. Premium wise on IUL, so there technically isn't a minimum amount that you need to pay in. Every year, cost of insurance will be charged to your policy. If you don't pay anything in, they'll just subtract that from the cash value. So there's more flexibility in that way. But the part that is maybe a con for some people is that the death benefit or the insurance part of an IUL is basically a renewable term policy. So as you get older, that cost of insurance will get larger because you're getting closer to later years when you graduate. If funded sufficiently in the early years, though, the growth that's happening on your cash value will far exceed cost of insurance that comes out, and it can be self-sustaining and really beneficial as your banking tool that you can still access via policy loans, used to supplement retirement. So yeah, I'd say with IUL, there's more upside with cash value growth, but less guarantees. Whereas whole life, you're growing at a 3% guaranteed rate plus a dividend on top of that. Let's see if I can do this well. I'll just do it over here. So yeah, the 3% guarantee plus dividend. The dividend, we've been in a low interest rate environment. Essentially what the life insurance carriers are doing is they're investing premiums paid to them across all their products into a really safe portfolio of corporate bonds, treasury bonds, commercial real estate, things that have very stable returns. And 20 years ago, some of those bonds were returning double digits. So the dividend credit to whole life policies was actually over 10% when with the 3% guarantee included. So there is some upside with whole life policies too. And actually, yeah, like seeing right now with the stock market kind of taking hits in our interest rate and rising, whole life and I kind of like play against each other, or like one of them can be doing well in time where the other one is not doing as well. So for me personally, I was mentioning this to Keisha of like, I have a whole life policy on myself and currently a term policy on my wife that we will convert to a permanent policy as once we get to a point where we're consistently maxing out my whole life premium. And yeah, I intend to start an IUL on my wife to kind of diversify among those products. But yeah, for each person, risk tolerance will be different. What you have available to fund the policy on an ongoing basis will be different. And yeah, we can walk through the different pros and cons to see what fits best.
And
So
the dividend on the right, that you said that tracks bond markets.
Yeah, often because that bonds make up a large amount of a lot of carriers' portfolios. So
commercial real estate, just safe assets in general.
Yep. Yeah, so fixed premium, and you still have flexibility with whole life premium between that the base premium and the total amount. So in that example I shared, if 100,000 is your total premium, only 15,000 of that is required to be paid in on an annual basis. And if in some year you could only pay in that 15, the next year you could actually back pay the 85 that you miss, catch back up. So it isn't like a Roth where if you don't pay your 6,000 in a year, you can't make that up in the next year. There's flexibility in both with premium, just with IUL a little bit more. So yeah, that's some of the simple differences between IUL and whole life. Both of them still have the borrowing feature, and both of them have the care for life, long-term care rider, just slightly different chassis.
How does the cash value compare on an IUL versus a whole life policy on the right?
Yeah. So early on with an IUL that has an early cash value rider on it, you'll have more access to cash value right away because the cost of insurance can be a lot lower early on in an IUL. It'd be interesting to, like 2010 to 2020, an IUL outperformed whole life because we were in that low interest rate environment. Stock market was doing great. But yeah, in this upcoming period, it may be that whole life outpaces IUL for a couple of years if people are getting a 0% credit during a negative overall year in the market. So yeah, like, I mean, with stock market history, like it's up more than it's down. So in the long run, you'd think IUL would do better, but dividends can be pretty significant in the long run too. I can actually, I can share briefly the policy that I used for the example, the 10-year example. Yeah, so 33-year-old that's paying $100,000 a year for 10 years. And yeah, cash value with the dividends added from the current dividend scale after 10 years of 1.2 million. And I mean, yeah, after year 10, I dropped down to just the base premium of about 16,000 a year ongoing. And yeah, you can see it in later years here, age 67, 35 into the policy, you're getting a dividend of 151,000 a year at the current scale, and cash value exceeds 5 million. So there can be pretty significant long-term growth on a whole life policy too. And yeah, with just less room for error if for some reason, yeah, you aren't funding premium anymore, and cost of insurance is chipping away more than cash value growth is happening on the IUL. So yeah, both products have a place. There's just, yeah, different things you got to compare as you make the decision.
Who would you say, or maybe what are some of the traits of people that IUL would work better for versus the traits of people who might be better suited for whole life?
Yeah, good question. I would say just greater risk tolerance on the IUL side, in terms of like they want exposure to the stock market still, and upside of that. There is a cool feature with IULs too, though, that after year 7, that's kind of the period that the government is checking the MEC test that I mentioned before, and you could dump in up to $1 million into an IUL without additional underwriting. So IUL can make sense if you're expecting inheritance or a large payout. That can be a place to house significantly more than what you scheduled premium wise 7 years in on an IUL. Yeah, I'd say younger. I mean, yeah, so IUL reduces cost of insurance early on. So if you're younger and you want to retain access to most of your premium in year 1, it can make sense to start with an IUL and yeah, and be able to put that to work right away. I had someone choose whole life over IUL recently, and they were looking primarily just at the guarantees and seeing like the worst case scenario on the whole life was better than the worst case scenario on the IUL. So for someone who has some of that in them, like I want a solid baseline, whole life can make more sense.
And so you think like higher risk, higher reward folks should choose IUL since it tracks the riskier, but again, higher reward stock market. And then someone who's more risk averse, wants more stable, consistent growth, should choose the whole life product since it tracks more stable assets.
Yeah, I think that can be a good gauge for people and where they land on either one. Yeah.
That makes sense. What other cool features would you want our listeners to know about, whether it's whole life or universal life insurances?
Yeah. Hmm. Yeah, I would say just to project like what could be down the road. Like it's possible to have multiple policies on yourself to insure different family members. When I reference like, the Rockefeller family and the Rothschild family, um, those families, essentially every time a new family member is born, they will insure them and have like the interaction between these policies and trusts too can be pretty significant when yeah, like when death benefits are passed on, they can be housed in trust. I think the Rockefellers, like, they allow family members to access fund policies and trusts for education, for launching a business. Um, so, yeah, there can be pretty significant stuff when you create a system of these banks through policies. And um, like for some, Nelson Nash, the guy who wrote the book Becoming Your Own Banker and kind of coined the term infinite banking concept, he got to the point where family members that they never needed to go to banks for anything. They could do a mortgage through policies that the family owned and kind of, in a sense, like cut banks out of their banking process and be the ones who profit from um, cash value growth and loan paid back to them. Um, so that's kind of projecting out what's possible if you really buy in. That said, yeah, for every person, how significant a part of your plan like these policies are will vary. And yeah, but I think at a minimum, it makes sense for most people to replace like an emergency fund with a policy because like at least that can be growing for you and be accessible when something comes up, but also be building a death benefit for you too. There's a proverb our team talks about quite a bit. A good man or woman leaves inheritance to his children's children. And yeah, I don't think many people have that long-term a vision financially in the US. And but it can be pretty significant if your ceiling is your children's floor and they can take impact even farther in the next generation. So
Yeah,
yeah, those are some thoughts, kind of bigger picture.
definitely deep thoughts. What would you ever, I wouldn't say everyone, a lot of people, a good amount of people have 401ks. And in your
Mhm,
one of your client case studies, you said that one of your clients took out, I think, 10% of their 401k and put it in
mhm.
infinite banking policy. Is that, how would you recommend, what's the best way that people can maximize
Yeah,
1k, but like obviously take taxes and everything into account and have like
yeah,
a life insurance policy?
yeah. So I can't actually I can't recommend that people withdraw from their 401k.
Yeah.
But yeah, like I can let people know that some people do make that decision. During the CARES Act with that client, that was a great chance to do that because the 10% early withdrawal penalty was waived. Um, but yeah, like I spoke to someone recently who took a 401k loan out for a fix and flip project. And yeah, just that the loan feature from a 401k often yeah causes like the dollars you take out via loan aren't growing for you anymore. There's a set payback period. It's just not a tool that's great for this banking process.
Mhm.
So I think in the big picture, some of what I shared, just like betting your 401k the same way you would other opportunities, and knowing, man, $1 million built up in a 401k can only sustainably provide 30,000 a year in retirement. Do
Yeah.
I want that to play some role in my financial plan, but maybe, yeah, only fund my 401k to the max rather than more than that, so that I can redirect some funds to a place that I can use today to buy other assets or develop other income streams. So it'll be different for every person. Some people want to be totally free from qualified plans. Others, yeah, like that kind of trajectory of an income stream that they can provide down the road. So yeah, that's another decision kind of walk through. Can be aware of, yeah, from a CPA or just looking up like tax rates and rules around your qualified plan, how much to set aside for a 10% penalty or taxes if that's a decision you make. Yeah, so that's a little bit on that topic. It's a good question.
So we have 4 or 5 minutes here. Another interesting topic, or way I should say, that I recently learned about using infinite banking is, and I'd love to hear what your take on this is, obviously. Let's say you have a big taxable event. Instead of paying taxes immediately, let's say you sell a company, you're selling an investment, let's say you make $100,000, $500,000, whatever the amount is. Instead of paying tax immediately and losing out on the opportunity cost of that money growing at whatever it could have compounded at, instead putting it in a life insurance policy, having it grow there, and then taking out a loan for whatever amount you need to go and then pay taxes.
Man, you are on it, Keshav. That's a great way to do it, to not just surrender those dollars to the government immediately, but yeah, capture their growth and still be able to pay the taxes when they're due, but not lose out on, yeah, what $500,000 could have grown to if it is really significant. Yeah, a lot of business owners are doing that rather than maybe setting taxes aside in like a business savings account. Just having a policy be where they store up retained earnings or taxes that they're setting aside so that, yeah, they can capture that growth. So love your thought process with that.
Okay, I think it wasn't my idea, so okay.
Yeah, essentially. So yeah, when I work with people, we do a pretty in-depth financial review and look at just your whole financial picture and where are there inefficiencies, where can dollars be redirected back to a banking system or to better vehicles that can help you get to where you're going faster.
Yeah. Well, wrapping up thoughts here, anything you would want our listeners to know?
Yeah, maybe just what I said at the beginning, like there's a lot of strategies out there. This is strategy that puts you in the driver's seat a lot more, puts more of the responsibility on you. But I think the stuff in you, the way you're uniquely wired, if that's empowered and you have money behind those skills and passions, yeah, I think your upside and doors that can open can be really significant. So I found that inserting the infinite banking concept into a person's strategy, maybe not in year one, but certainly very soon, like when you have dollars just sitting, it's like, those are growing for me. I could put them to work too and still have them growing for me. And when that happens, something just gets unlocked that's really cool. And yeah, where I am 3 years since learning about this is totally different than where I would have been had I just continued kind of default funding qualified plans, which is what I was doing.
Yeah. All right. Well, thanks so much for joining us today and introducing us to this world of banking on yourself, having your money work for you twice. Again, once in a life insurance policy and once in your investments. your contact information as well, and hopefully people reach out to you, and hopefully we all learn a little more about how to build our wealth for ourselves.
Yeah, awesome. Thanks much for having me, Keisha.
Yeah, anytime, Jack. Thanks for coming